friends. Welcome back to the Wall Street Skinny. I'm Jen.
I'm Kristen.
And we are two lifelong friends with a combined 25 years of experience working and teaching on Wall Street, here to give you the skinny on the world's highest paying jobs. So Kristen, I think as of today, we have something like 85 or 86 episodes under our belt in just over a year of podcasting. But what is shocking to me is how many gaps in our curriculum we still have. And there's so much I'm excited to cover. And today is one of our first forays into, I would argue, probably the topic we get asked to cover the most, which is private credit. And we are going to tackle this from multiple angles all summer and all fall. Well, I guess all summer. What is it? Mid-July. Okay. So late summer, all fall, into the winter, we will be talking private credit. Also, this is going to be one of our first big conversations around securitized products, specifically CDOs and asset-backed lending.
Well, it's funny because CDOs and securitized products in general, I think that there is this whole world that most people don't really understand. And, it's funny because we get asked a lot on social media, like, well, what's the difference between structured products and securitized products? And, it's almost like this black box that most people don't really understand. And again, the only reason that I understand it even a little bit is I started my career in CDOs in 2007. And it's funny because that was such a dirty word. Like, it turned into this thing that people almost saw as this like toxic products, like people were creating this stuff, putting it into the universe. And the funny thing is, like, it's still around and it's actually a necessary part of, the way, for example, like the mortgage market works. And it makes sense, right? It's an integral part of the entire world of finance. But because of the 2008 financial crisis, people didn't really understand it. They didn't really want to go into it. And I think what's so interesting, especially with the conversation with Keri, is I mean, look, it can be a wildly lucrative career. One of my friends who has been the most successful of the people that I know who work at a hedge fund, like, happens to work in this particular niche. So I really am excited to talk about securitized products. It's coming back.
Yeah, and it's coming back in a big way in the overall context of private credit, which again is one of the things that we get asked all the time. Hey, what is the career path to breaking into private credit? So we're going to talk about that from a couple of different angles. Like you mentioned, Kristen, we're sitting down today with Keri Findley, who is the founder and CEO of Tacora Capital. It's a private capital investment firm that launched just a couple of years ago. And Keri's a contemporary of ours. She's basically our age. She started her career in the research arm of the sales, trading, and research division of Morgan Stanley, where, Kristen, like you said, we both started our careers. And we didn't know Keri at the time, because she had a very quick exit from research and sales to the buy side. She ended up running a massive portfolio at Third Point, which is one of, I would argue, the most well-known and respected hedge funds in the world. And now she has since started her own firm. So for anyone looking to get a taste of securitized products or private credit, we have kind of a bit of a crash course here in both. And for anyone who's looking to better understand the high profile exit opportunities from fixed income sales, trading, and research, or the debt capital markets division of a bank, you need to listen to Keri's story of both her meteoric rise and her guidance on what she looks for when she's recruiting top talent into her firm.
And the other thing that she gets into, which I think was just really, really fascinating, is why she makes all of her new hires sign a prenup on their Keri. So if you're curious as to why that is, listen to this episode.
We are joined here today by Keri Findley, who is the founder and CEO of Tacora Capital. She was introduced to us by our dear friend and one of our all-time absolute icons, Joanne Bradford. And Keri, I'd love it if you could quickly just walk us through your background, tell us how you got into finance. I know you started your career at Morgan Stanley, where we both started our career, and talk to us a little bit about your product specialty. And before we get into it, you are literally the first person we've had on the podcast who is an expert in securitized products. I know Kristen has some background in it. I have none. So it would be incredibly helpful if you touch on that aspect of your background as well.
Awesome. Happily. So I'm Keri. I grew up in Los Angeles. I figure skated my entire childhood and teenage years. And then I went to Columbia University for college, and I called my dad and said, "Hey, Dad, I want to stay here for the summer." And he said, "Well, it's time to get a job." So I applied to every job on the Columbia job board. And Morgan Stanley offered me a job in something called ABS CDO research. And that stands for collateralized debt obligations of asset-backed securities. I showed up, I sat down in my seat, and I was put in this research division.
And remind us what year that was.
I think it was 2005. And I sat down and was doing things like research on wharf drift, which was weighted average rating factor.
Oh, I didn't even know that term. Kristen, I bet you did. That's a new one for me. Wharf drift. It sounds very Star Trek-y, which I love.
Not wharf drift, but one of the things that back with the whole CDO product is that it was sort of like a rating agency arbitrage, because you would take these bonds that were rated, whatever, call it B, but like when you pull it together, because you now have this diversity, in theory, you can like have higher rate. So anyway, you trudge and stuff out, but some of these terms are coming back, but I only worked with CDOs for all of like 3 months, but yeah.
Not much longer. I was there for less than 2 years, and I had 2 jobs while I was there. I started in research, and then they moved me to sales. But in research, I worked for this really great guy who, like, every week would say, "Come up with 3 to 4 things you want to research this week," and I'd come up with 3 topics. He'd tell me which one worked for him, and then I would do some analysis on it. But yeah, it was the analysis of aircraft leases and loans, manufactured housing, franchise, mortgages, auto loans, credit cards, and student loans. And exactly what Kristen said, they'd put them into a pool and do a ratings arbitrage, and you'd pop out all these AAA bonds. So I'd be on the phone with insurance companies, and the insurance companies would be like, "Why does this bond I bought from you at 100 cents on the dollar now trade at 30?" And I'd be like, "You didn't buy it from me. You bought it from Morgan Stanley many years ago." And yeah, so these CDOs were created between 1999 and 2003.
Wow.
And they had Metris credit cards, which was a big default. They had a bunch of subprime auto loans, which were big defaults. Long Beach mortgages, a lot of defaults. And so my first job, even though it was in a relatively bull market, was a very distressed type job.
Got it. Which makes sense, because I want to remind people, like, again, leading up, so because you were 2005, that's why I was asking, because the great financial crisis was 2000 and, I mean, we started to see like signs going into 2007, 2008. Like that's when I joined in CDOs, was 2007. And like shit was starting to get scary. So the actual, I mean, Jen, when she was at Lehman, like that didn't happen till 2008, but still like you were starting to see the signs that things were starting to go bad. And it's interesting because, I mean, obviously we're going to get into this a little later, that what's old is new again. CDO stuff is coming back around. It is. It's like this private credit field, but it's so interesting that like this was this big thing. Obviously, there's been now new regulations and things that are put in place to prevent the very bad outcomes. And I think people now realize that like just because you pull things together doesn't mean that the correlation of different assets is like zero.
No, totally. It was great. I mean, I learned so much there. I was so thankful for it. But I went from there to a fund called DB's Wern, and I worked for like these 2 amazing guys. You know, sometimes in life you see who you want to be and how you want to emulate. And I worked for this guy named Ray Chan, who is still, I consider, a mentor to this day. I was the associate analyzing residential real estate lending transactions and consumer lending transactions. DB's Wern started going out of business into the financial crisis, actually not because of bad performance, but there's a bunch of stories about it. The founder like accidentally bought a private jet with investor capital.
Happens to me all the time. It's really pesky. Like, I just don't understand how I bought one this week accidentally. Sorry, Kristen.
Yeah,
but he returned the money, but the firm still went out of business, like due to lack of controls, lack of faith in their operations. And they were looking for a place for the team. We were all trying to go to a place called EOS. It didn't work out. I ended up there for a few months. And then I got an offer to start and run the structured credit business in my mid-20s at a hedge fund in New York called Third Point. And that was pretty crazy. You know, you're in your mid-20s, you're like, you don't know what you're doing. I actually like started writing my business school essay called How I Conned Third Point into Thinking I Knew What I Was Doing, and blew up the firm.
Oh my gosh.
Obviously never I started the essay, never finished the essay, and never applied to business school because it ended up going so well.
Never blew up the firm. Let's also put
Right.
that in there.
Exactly.
And third point, I think for some, maybe not all, but third point's kind of a household name, just like Morgan Stanley. I think it's definitely one of the bigger names on the buy side that a lot of our audience will have heard of. But for those who haven't, can you describe what the strategy, the overall strategy at Third Point was when you joined, and then what your specific area was?
Third Point was an activist fund. They gained their notoriety and success by kind of pushing corporations to follow what, you and I would call just normal guidelines, whether they had corporate greed or they were spending too much or weren't doing things to maximize profits. Third Point's history was that they would write a really aggressive, nasty letter and get the company to change and create value for themselves and for other shareholders too. When I joined, they were trying to shed the activism name and they started using a name called constructivism, and that they would work with the company to help the company create change. But I joined and they wanted to be in structured credit. And at the time, Third Point had a rough 08. I joined kind of after that. And then they needed, someone to start a structured credit business. Dan always said age adjusted. I was the best person he met for the job. I always wondered how much age adjustment went into that, but I was young. I didn't know what I was doing, but I figured it out very quickly and figured it out on the job. And the first few years I was there, the way I looked at things was, I would say, a little bit different than our competitors. So most of our competitors would hire 10 people. One of them would be in prime mortgages. One of them would be in subprime mortgages. One of them would be in auto loans, in student loans. And I looked at it backwards. I was like, okay, let's take the entire structured credit space and figure out which of those subsectors are the most interesting right now. And then I would fill those boxes with product. So I would say, okay, Alt-A mortgages that we can turn into re-remics or re-securitizations or restructurings. I know
you're going to kill me. You're going to kill me. We have a rule on here that you can't use jargon without defining it. So, I did. We don't want to paint you into a corner having to define every single term from there. Just generally speaking, could you explain what those categorizations refer to writ large?
Yeah. So during the financial crisis, bonds that had been previously rated AAA were downgraded to levels like D. And, a rating agency downgrades you to D or default if it's just $1 of default. But so you had $100 million of an Alt-A mortgage bond, and the losses to hit it were going to be somewhere between $1 and let's say 20%. But you still had 80% of bonds that were really safe. And so the investment bank would take those bonds and show them to a rating agency and say, how much would you re-rate, whether it was AAA because the customer needed AAA or single A because the customer needed single A. And the rating agency would say somewhere between 60 and 80%. They would take this bond and they would split it into, let's just say, a 60% senior that was rated AAA and a 40% mezzanine bond or junior bond. And then we would keep that 40% mezzanine bond. The bank would get back its AAA security. And we created a bond at a really low dollar price that still had interest priority. It just was subordinate by principal.
Wow, that was actually a really good explanation.
We could create these bonds at the beginning, 2 years of coupon payments. So the bond was paying a 5% coupon. We were buying it at about 10 cents. And if it just made it 2 years, we were going to get all our money back that we paid for it. If it made it a lot longer than 2 years, we would get a lot more interest. And if things got better and the AAA bond paid off at par, which we thought it would, we would get some principal too. And so the bonds just had what I would call an unbelievable convexity profile, where if things went really well, you made a lot of money. If things went really badly, you probably didn't lose so much. And I really liked that and thought that was the most interesting investment and started loading our book with them. And that went really well and kind of springboarded my time into Third Point and my time into managing this business.
How much of your ballsiness with that strategy would you attribute to the age-adjusted time in which you came into the industry, because this is something I think about frequently, that there's a whole class of industry leaders and experts that we talk to who are kind of the similar cohort of like started just before or like in and around the financial crisis, who had never seen what things were like in the 80s, not to be like Magic 106.7, but like 80s, 90s and today, right? Had only really seen what happens when shit goes bad, and came of age and came of expertise in this new world order where it was QE forever and Fed intervention and massive recovery on all these things. Like, how much of that was, do you think, a function of the timing of the markets when you started? And how much was like you saw something that no one else saw or had a higher risk tolerance?
So I think it's a combo.
I'm also curious, like, what it was about you that made Third Point say, we want to hire you and put you in the seat at like an age 25. And clearly they bet on someone who had killer instincts. So echoing Jen's question, what do you think it was that made them look at you and say, hey, I think that she has what it takes?
So I actually am confident at what it was. I think it was that I could explain things in plain English.
I can tell, like, you are really gifted at that.
And I think if you're someone like Dan Loeb or someone like Third Point, if you can't communicate with your new portfolio manager because they're speaking mortgage and you're speaking the rest of structured or the rest of finance, it would have been a really tough sell. And I think that there were a lot of people who, you know, who I knew, who I didn't know, but who were part of this business, who got so caught up in the jargon that they couldn't just explain the risks, explain the upside, explain how it went from there.
Yeah.
So I think it was a lot of timing, obviously. I think there was something about the fact that I was too young to just have been traumatized by what happened. You know, I think that at the beginning of the crisis, the people who had been doing this for 10, 15, 20 years would say, okay, it can't get that bad. It'll never get that bad. The government will step in. And so the kind of what I call I jokingly, but like call them the lemmings, all had the same view that it just like couldn't get that bad.
Yeah.
And then once it got that bad and 10 times worse than they thought, they were so traumatized by it that they couldn't take the risks I took. And like, if I told you how many people said things both to me and behind my back, like, let's try to figure out how Keri runs this bond. I mean, Keri's going to blow up Third Point. Keri's going to blow up this market. It was like pretty wild to look at what I was doing versus other people's view of what I was doing. No, I'll be clear. Not a lot of people told me to my face at the time because they wanted me to buy as many bonds as possible. Right. But there was this one guy at an investment bank, and I remembered he showed me this bond, and you know, the jargons and the name of the bond is kind of irrelevant, but it was a Centex bond, originated in 2005. It was an M5. It was an original, a single A. And he said, I run 3,990. And I'll explain what that is in a second, but I run 3,990 and I still get a 7% yield. What that meant was he was defaulting like 95% of the mortgage pool. And what I would say is like the trauma that got him to do that was losing all his money on a lot of bonds.
Yeah.
Well, but I could look at these bonds and say, okay, are 95% of people who have made 60 months of mortgage payments really going to default in mass now that they've made 5 years of payments? You know, I found this great chart. The chart showed me that 97% of people who defaulted on their mortgages defaulted by month 60. So now we're looking at like, okay, we're saying that only like 10 or 20% have defaulted by month 60. Like there's something in between that has to be the right answer.
Yeah.
And so I would view a lot of what I did back then as naivete and also being young and not having the trauma, but also being able to look and take a step back and say, okay, what if it's not as good as it used to be? But what if it's not as bad as everybody's fearing? How does that get us to a place where we can earn a really great return? And so I would look at that and I would create these boxes and say, okay, the parts of the structured credit market we want to buy are, one time it was US subprime mezz, at another time it was Greek RMBS, at another time it was consumer loans from fintech companies. And so I just kind of fit in where I thought the market's assumptions of loss and risk were wrong, and was able to duck and dive and be able to be small enough, you know, run a big business, which was a multi-billion-dollar business at Third Point, but be small enough that we could operate within the different market segments.
Yeah. And one thing I think is so interesting during that time, it went from structured credit to being this like big, sexy thing to being like, no, everyone was terrified of it. Nobody wanted to touch it, right? It was this scary word, whatever. And you also had all these almost like forced sellers of a lot of actual good assets. So you had these weird things where very secure AAA CLOs where the default on those corporate bonds and loans was like still 2%. And yet they were trading at these like ridiculous prices. So it was like there was this huge dislocation, 2008, 2009. So I feel like you also, from a timing standpoint, I would assume there must have been some like just really great opportunities.
Oh, for sure. The timing was super lucky. I mean, I really joined Third Point at the bottom of the market. Early 2009, everything was just being sold, being force sold. I mean, I'll never forget, I started there, bought a handful of bonds my first few months. And again, someone at an investment bank who was trying to sell and buy paper from me was like, hey, just so you know, March quarter end was really bad. June quarter end's going to be worse. We have all the information, all the knowledge. It's going to be way worse. Sell me your bonds before June quarter end. And I was like, okay, like, how are you going to profit from this? Like, let's think about that.
Keri, I get a sense from you that you have succeeded in no small part to not really caring what people are saying about you, which I absolutely commend and admire. But when we connected a couple of weeks ago, we had put out a silly reel about like things we did to fit in an investment bank. And you wrote us a note saying like, oh my God, you would not believe some of the things I did to fit in. I'd love it if you could tell those stories. I'd love it if you could share kind of how you navigated that whole, hey, people are going to say what they're going to say. I feel comfortable with this risk and being so confident and being such a bold risk taker with also sometimes caving to those pressures and how you balance that.
I mean, I'll be honest, it's a tad of an act. It's fake it till you make it. It is really hard to have people say bad things about you. People say bad things about me all the time. I often throw myself a pity party. I cry, I get over it, and I move on. And what I would say is like, I obviously appear to have a lot of confidence. I know that. Like, my confidence is skin deep. It's there until like one day something someone says about you really hits you. And then like, it takes a couple days or a couple weeks to recover. I mean, I reacted to that because I actually taught power skating to guys at Morgan Stanley who were on the Morgan Stanley ice hockey team. I learned how to chug a beer. I didn't learn how to chug a beer in college, but I had to do it because Morgan Stanley, like Conference Room H was at 5 p.m. and Conference Room H, if I'm sure you guys remember, was a bar called Hurley's.
And, of course, Hurley's.
Yeah. But it was hard. And like, I'll never forget, I was probably 21 or 22 and I was told to get this request for a client. And I walked over to the guy who was supposed to fulfill my request and I asked him to do it. And he said something, kind of glib, like, come back when you can spell the word mortgage. And I was like, what? God. And then this other girl who was in my analyst class went up to him and she asked for something similar for her set of clients and he did it. And I went to the sales guy and I said, hey, what do I have to do to get him to respond to my requests? And he said, look, Keri, she looks like a swimsuit model. You just don't have that. And so you're going to have to figure out other ways. I mean, those things were constant throughout my career. And look, they hurt. It's hard. But you have to grow a thick skin. You have to find a way around it. You have to find a way over it. And even to this day, if I told you I went through a really nasty divorce, which can obviously get us to the prenup question. But
oh yeah, nice segue.
If I told you how many people say things like, there was a lot of litigation related to my divorce and it sucked and it was terrible. And I don't want anybody to go through it. But if I told you how many investors say things like, what did you do to him to make him hate you so much? Or this amount of litigation is a real problem for us. And it sucked. I don't hide behind it. It is what it is. But the number of people who think that that is a substitute for hard work and good returns, my returns at Third Point, I think were somewhere in like the mid-20s IRR unlevered over a very long period. The returns of Tacora today, I think for Q2 are going to be something in the 30s net to investors. Nice. It's been incredible and I've been very lucky. And obviously there's a lot of hard work that goes into it. But when investors say things like, this is a hard one for us because of your divorce or because of the situation surrounding it, like, It's hurtful. It sucks. It's no fun. I don't wish it on the future generation. I don't wish it on anyone, but it makes me want to succeed more, and it makes me want to push harder, and it makes me want to help other young women so they don't have to deal with this because, unfortunately, I know I am confident most of the time. I definitely have my moments and throw myself my pity parties and all that kind of stuff.
Can I ask you a question? And this is not intended to be leading the witness. This is a legitimate question. I know and can name and will not name off the top of my head at least 10 male founders of funds who have been embroiled in litigation over their divorces at multiple times in history, not just one.
Yeah.
Do you feel like you are getting specifically called out on it? Or is this how this goes with everyone? And that's why you've decided to be strategic about, having conversations with people about the prenup issue that we'll get to?
I met with this wonderful woman last week, and she is the CIO of an OCIO. And she said that, from her experience, women get asked about this. Women have higher problems with this. She said she has an equity manager who's actually a good friend of mine that they're invested in. And when she got married, there was a bunch of commentary about it. Like, oh, do you think she's going to have kids now? Oh, do you think she's still going to be focused? And she said she's never received those questions about a male manager. So I do, but I think, that's a societal issue and less of a finance issue. There was actually this wonderful woman who is probably the most successful self-made woman in America, if I had to guess. And she runs a options trading business in Chicago. And, I was telling her that this was an issue. And she's like, my now husband and I were running this business together, and we both got divorced from our previous spouses and got married. And she said, what I did to get around investor questions about it is I put him in front of investors. Nobody asked him, but yes, they were going to ask me. So, if you take those data points, you get there. It's sad that that's how people react. But at the same time, I can't change society. So all I can do is react the best way I can to it.
I love that answer. I think that makes a lot of sense. So let's talk about Tacora. And can you tell us what the process of starting your own firm and fundraising and everything has been like? How did you have the guts to do that? What inspired you?
So I never wanted to have my own firm. I always wanted to hide behind someone else. If you think about it realistically, Third Point was the perfect kind of setup for me. I got to run my business. I dealt with just the street. I obviously met investors, but raising money was not my job. Third Point had one kind of strategy that was in 6 funds, but not for different strategies. And so I got to just do my thing and invest. And when I left Third Point and I realized what I wanted to do, I wanted to kind of focus on this more illiquid part of the structured credit space, which we call private credit, we call asset-based lending, we call it whatever we want to call it. But that wasn't going to fit within Third Point, which offered their investors 90-day liquidity. And so I looked for other people to do it with. I really did. I spent time kissing a lot of frogs and tried to figure out another place where I could have the same setup. And at some point, I just realized it wasn't possible. And every firm has bureaucracy by the time they get big. And so as I was spending time with other firms, it really was, okay, it's kind of like dating. Do their problems match up with problems I'm willing to live with? And in some cases, yes. In some cases, no. But I just realized at some point that the only way that I was going to get this done was to do it on my own. And, I was kind of at the time spending some time with a group from a private equity firm in Boston, and they were really great. And, they had offered to seed us and raise capital around it. And then when I was at dinner at Peter Thiel's house in February of 2021, and he just kind of came out and said, I didn't ask, I wasn't pitching him. He just kind of came out and said, I'd love to be your biggest investor. And
that's so cool.
And he's like, how much money do you need to get to the full first fund? And I said, I don't know, 250. And he said, let's do it. I'll do all of it. I'll do the whole fund, somewhere between 250 and 300. And it was an unbelievable compliment and so humbling. I've looked up to him for something like 20 years. And so to have him put that on the table at dinner was something I was not expecting, but really out of this world. And all I can do to return the favor is hopefully make him a lot of money with the money he invested.
It's so funny because Jen and I are working on our course right now, and I was using the example of Peter Thiel, I guess, investing like $500,000 in Facebook in, I
Oh,
think it
I'm
was
gonna be
like
sick.
2005 or whatever, 2006, and then turned it into like $1 billion. And it was something like 159% IRR. But I mean, I didn't realize, I mean, obviously it makes sense. He has a lot of money. He's going to like spread out his investments, but he's just obviously such a well-known venture capital investor. That's like, I mean, very cool. It's clearly he's looking into private credit.
And speaking of private credit is one of those things that wears so many different faces. And we've got a number of upcoming interviews with people from all different aspects of private credit. But you talked a little bit about asset-based lending. Can you explain what that is and what that vertical within private credit looks like and means?
Yeah, so private credit I just view as credit that's not CUSIP'd, and a CUSIP is a bond. So if it's created to a bond, it's public credit. If it's not, it's private credit. And then private credit has a bunch of verticals, the most popular being direct lending. And I would actually say that like separating ourselves from that is important because we don't take the same risks. But asset-based lending is you are lending against an asset. It can be a physical asset. It can be a financial asset. We mostly focus on financial assets. And so we lend against loans, leases, invoices, purchase orders, receivables, statutory capital, and then a little bit of hard assets, meaning something like houses or equipment.
So actually, really dumb question. How is that different from normal direct lending that's collateralized?
Well, so direct lending, if you're lending to a company, you're lending probably collateralized by the company. It's collateralized by the good faith and credit of that company you're lending to, by the revenues, by profits. This is not. This is, there are loans behind you. So let's say that there's 100 million of mortgages. Those mortgages are obviously backed by houses, but our loan would be backed by the mortgages or the consumer loans. And so you can run a stochastic analysis. If, it's funny, I took a class called Stochastic Calculus in college. And it was the only class I loved in my 4 years there. And then at Morgan Stanley in ABS CDO research, I'm running a transition matrix on defaults one day and looking at, okay, how many loans that are current go to 30 days delinquent, how many loans that are 30 days delinquent stay there or go back to being current again or go to being 60 days delinquent. And I was like, oh my God, this is stochastic calculus. And I don't know how, I got put in a seat that took the only class I loved in college and applied it to financial services, but it did. When we look at loan portfolios and we look at lending against loan portfolios, we are running a stochastic analysis that's how many of these loans will eventually get delinquent? How many of these loans will eventually default? And then we set our rate and our LTV based on what we think defaults are going to be. We put a multiple on that, and then we lend it something where we think I'll get our money back. But we are not lending against revenue. We are not lending against the good faith and general obligation of the company, which is what normal direct lending would be.
Cool.
And one other thing, I actually love that you explained the difference between private and public credit as just like, is there a CUSIP or not? But you had mentioned previously that it was important to you to have, with Third Point, they had like a 90-day redemption period, it sounded like you could ask to redeem and then you could get paid back. And it was important to you to not have that because it sounds like if you're doing private investing, you can't have your investors pull money out because you have invested, I'm assuming, for like a longer term. So was that the main reason why you needed that longer time period lockup?
Yes. I mean, our loans, we love them. We think they are great and we think they're going to pay off at par, but they're small. We do loans between mostly 10 and 40 million. They are illiquid, and finding someone to take them over is always going to be difficult. And so if our investors asked for their money back, it would be very hard for us to sell the assets that we have on our books.
Got it.
That makes sense. And when setting up the firm, our friend Joanne had mentioned that you require other members of the firm to have prenups on their carry. Can you talk a little bit about that? Carry for so many people is something everyone's like, oh yeah, it's the good stuff. It's the stuff I want or whatever. But so many of the actual mechanics of how that carry is distributed and accessed and how it's accounted for remain a little bit of a black box from firm to firm or kind of asset class to asset class. And I'm curious how and why a prenup plays into that.
I mean, I learned the hard way that when somebody wants money, they can do anything they can to get it within the legal system. So my ex subpoenaed everybody he could in my work life. He asked for records. He asked for testimony. He did a lot of things to try to make my career tougher. And, it's the last thing you need. But I look forward in terms of my firm and my employees. And one, they work really hard. They are awesome at their jobs. And I am so thankful for them. But if they leave, I want them to keep that value. And look, if they have kids with their spouse, it's always their choice of what to give them. But I don't want to deal with Tacora dealing with the litigation that, my ex put my ex-employers through. And I don't want to be sitting there testifying about how much work they did, what they did, when they did it. And so the easiest way to set these things up is up front. I have this absolutely wonderful 30-year-old managing director at Tacora. She's incredible. And she got married last year. And to sign her Keri agreement, her spouse had to sign an agreement that he has no claim to it. It's not his. And it's not requiring them to have a full prenup. It's just requiring that they sign away their right to it now. Mm-hmm. And it will be distributed at the end of the fund life. Fund 1 was a 7-year fund. Fund 2 is going to be a 5-year fund. I just think that having a situation where we are in less litigation, where our investors have less risk of that is the goal. And it's always been the goal. And so if I can protect myself from it, if I can protect my investors from it, our companies from it, that really is the way I want things to work and the way I want things set up. We have another young woman on the team who's amazing, and she's not married. So obviously there's nothing for her to sign at this point, but it really just is saying okay, I understand that my spouse worked here, did this, and I'm saying now that I'm not going to start, let's call it a World War III to try and find out how much value is there and how I can get my hands on it. And you just make them sign it away day one. I hope it works well. I can't promise it will, but that's the goal I'm setting up for our team.
I mean, and I hate that you unfortunately learned the hard way yourself, but I think that that's just it makes a lot of sense, at least from an outside perspective. You've mentioned this young superstar team that you have on board with you. Where are you recruiting these people from? What is the path to come work for a firm like Tacora, other than obviously taking stochastic calculus, which this will come as a shock to no one. I did not take as an English major in college.
So we have a really weird recruiting process. Everybody on the team, something that runs through all of them, which is that they did East Coast finance and they did something either entrepreneurial or with a startup. So if you look at Claire, she was a UVA Jefferson scholar. She went to Goldman Sachs leverage finance out of college. Mm-hmm. And then she joined a startup called First Dibs. And, she has the rigor of the underwriting, but she also has the empathy to deal with startup founders. And I think that's really hard. Megan, who's also really awesome, who's on our team, she joined us a year ago out of SVB. I mean, SVB is the perfect training because she had the underwriting expertise, but she also came from a startup. And our COO, same thing. He was at a fund that did kind of lending stuff called Rock. That was a spin out of Deutsche Bank at one point. Mm-hmm. And then he rolled up 300 Popeyes with a couple partners and then sold them to a private equity firm. Mm-hmm. So understanding both the underwriting and the financial rigor, and then being able to understand the founder path, understand founder empathy. The companies we lend money to, we're always comfortable with the assets we lend against, but these companies can be roller coaster rides. Mm-hmm. They have moments of almost insane success. They almost fail. And then most of them make it out of it. But having empathy and being able to know when the issue is going to affect our capital and knowing when we should just let it ride, because while the company may be having issues, our capital is pretty safe and secure, is a hard judgment call. And having people who've seen both sides is really important.
That is really interesting.
Yeah. And I've said this so often that, I don't think everyone should be going to work in investment banking for the long haul, but I think it's a great training ground for networking and just learning some of the basics. But then obviously Jen and I, having started this, being a founder and doing everything where you have to figure shit out, having the combination is such a, I think, really valuable skill. You've gotten sort of the hard work and the rigor working for these large institutions, which again, there's things that people think are so dumb. It's like you have to be the first one in, the last one out. But it's like, I don't know. I still think like some of those things and just like how to deal with people can help. But then on the founder side, you have to just learn how to figure shit out. And no one's going to tell you, no one's going to give you training on like, this is how you file this dumb document that is impossible to figure out on the Massachusetts like website. So I think that that's such a great combination of having that sort of more very traditional finance with then the founder mentality. I think that's really cool.
Yeah. I mean, it's funny. Like, what did I do at Morgan Stanley? I was the first one there every day. I got in at 5:45. I printed out the offering packet for the salespeople.
Oh, the printouts. Oh God, the printouts. We single-handedly deforested the Amazon with the morning printouts on the race desk at Lehman Brothers.
We did have one day where we went and we planted trees. So that makes
there you go. You gave back.
Kidding, yeah.
No, but that was actually like a skill on which you were evaluated in those early days. I'm sure it was similar for you, right? But it was like, did you get the order of the printouts right? Like, is everything there?
Did they look good? Was the staple in the right place?
Yeah. Oh,
and then
staple.
It was, yeah.
Mm-hmm.
The staple hanging off the edge. I mean, you might as well just hand in your ID and leave right now if that staple's hanging off the edge.
And then I got that feedback from MDs. It needs to be 45 degrees.
Yep.
Okay.
But then it was getting breakfast right, it was getting lunch right, and it was getting coffee right. And like, I know those things seem so ridiculous, but there was this funny book I read called Bond Girl. It's
oh God, I read that. So like, I worked for all the guys that she wrote that book about.
Oh, that's really funny. Yeah, I mean, the stories of her like getting the wheel of cheese.
The wheel of
Bronx,
cheese. Yeah.
I can't say I got a wheel of cheese from the Bronx, but like, I had to balance pizza boxes. I had to carry things in high heels. I mean, it was like the lessons you learn really are applicable as much as like it seems ridiculous at the time.
I also think it does help you develop a slightly thicker skin, especially having worked on the trading floor. There is like just good character building things that come out of that. Granted, I do think nowadays it's gotten a little tamer, although maybe not, I'm not sure. But I assume on the trading floor environment, it's definitely not Wolf of Wall Street. When we started in like the 2005, 6, 7 era, things were already a little tamer. But
I still hear wild stories from people, but maybe they're less like, look, I don't think the like, we're going to funnel beers until 2 a.m. and how many, I think one guy used to say, if you're not on my team at night, don't be on my team tomorrow morning.
Oh my God, that would not fly today.
No. And like funneling beers was like not my specialty. I'm more of like a tequila soda kind of gal.
Jen was saying, I think at one point we got we had some of the nastiest comments online, but Jen's like, you have no idea what I've heard from some of these hedge fund portfolio managers and some of the stuff they would say to me.
There's not a ton of social etiquette. And like, as long as people allow it to fly, it will, but someday it'll have to change. It's just a matter of when. And, I would think by now we would see more young women in the space. I still think it doesn't seem to be sticking, which is, I find frustrating and sad. And like, my view is that like, if I can do anything, it's grassroots, help young women get in this industry and stay in this industry. I mean, even my analyst class, I think was 50% female, but by the end of 2 years, most of the women were gone.
Yep. I saw that all the time. When I would do training, it would be 50% at the analyst level. By the associate level, it was like 30% maybe. And then it just continued to thin out.
Well, so Keri, I mean, senior doesn't even begin to describe you, right? I mean, you're the head of a fund. Like it doesn't get more senior than that. So my question for you is, what do you see the landscape on the buy side looking like? Because we know we kind of parsed out what it looks like on the sell side as far as senior women and where there seems to be a cliff. Do you perceive that same cliff exists on the buy side?
I mean, I think it does, but I think it's what people have always called the pipeline problem. Kristen just described it. It's like if you're 50-50 at the analyst level and then you're 70-30 at the associate level and then it thins out from there, those VPs for the most part are who are getting recruited, or maybe it's associates getting recruited, but you continue to see that thinning. There are women, they're just not enough. And I don't know if it's poor treatment. I don't know if it's the hours. I don't know if it's I don't like the work. I don't know what it is. But, I would say the best moment of my career, I was still at Third Point and I was at a golf event at Hudson National in Westchester.
Yeah.
And it was a women's event and I was sitting at a table of 10 women. And one of them said, oh yeah, Keri introduced me to my job. And I don't know what was asked to her, but every woman at the table had been introduced to their job by me. And
I love that.
they were a young woman in sales and trading and research and something at an investment bank. And I had a friend who was looking for a great associate, and I would recommend them. And they were great, and they were getting hired. And so I just think there needs to be more of that. It needs to be grassroots. I don't see like an institutional way to fix it. I don't think these groups of women getting together are fixing it. Maybe it helps. Maybe it helps know where job openings are. Maybe it helps know where opportunity is. But my investment team is all young women. It's not by design. It's actually that they were the best people I met for the job at that time. But I do think hopefully they stay with me for a long time, and hopefully they like working at Tacora. I think they do, and they're great at their jobs, and I'm very thankful for them.
I think one of the other things that hopefully people like you being in these very senior roles, it starts to also just change the perception. So to see success stories like you, where it's like you are the head of this fund, you are doing incredibly well. I mean, I think that the more we have people like that, it starts to make it so that this background noise starts to change. I think that a lot of it is just, it's what you get used to, it's what you see. And so having those role models, I think, is really important.
Yeah, I think so. I think the other thing that I've noticed is that, in my opinion, in some cases, women are held to a different standard. And so we can talk about the comments I've heard about, my ex, but, I think it is also like they want kind of the perfect person, and I'm not perfect, and I don't think anyone's perfect, but I'm probably more flawed than most. And so you're
in good company here, friend.
But so that's the other thing that has to change. And I don't know how it changes, but it does. And so, you have women who can be women's worst enemies. You have men who are commenting on women's personal lives. I think those things really have to change too. I don't know how you do it, and I don't have a solution, but if I could offer one, it would just be for people to kind of think about it when they say it. And maybe say, oh, well, why do I care about that? It's not important. I know this awesome young woman who runs a biotech investing fund. I know this awesome young woman who runs an equities long short fund. They are out there. They're harder to find. And in the private credit world, you have to make a decision, hopefully pretty early on, which is do we want to have great AUM or do we want to have great returns? And we want to have great returns. And our goal for Tacora in the future is to do really well, earn a lot of carry, invest it back in the firm, and eventually just not have to fundraise unless we want to. And so, for Tacora Fund 2, we will take outside investor capital, but that's unclear, depends on when Fund 1 carry becomes liquid. I will invest most, if not all of it, in Tacora Fund 3 or 4, depending on when that's liquid. And then you kind of can have your own destiny, and your returns speak for themselves. We want to have really high returns. We don't want to be an AUM gathering firm. And I think that AUM and returns are totally inversely correlated.
Ooh, say more.
When you have 100 billion of AUM, it is almost impossible to find 100 billion of really high returning deals.
Yeah.
If you have 50 billion of AUM, well, that's easier by half. If you have 25 billion, that's again easier by half. But if you're running $500 million, which is, what we want to run for Fund 2, we're looking at a situation where we are a small, minuscule part of the market. So we can choose the deals that we think are going to have the best returns. And, the big firms, the big $100 billion firms, if they look at a $20 or $30 million deal, the amount of staff they would have to deploy that $100 billion of AUM is just astronomical. They can't do it. And so us and our team of 7 can look at deals that are $20 to $40 million that have higher returns that other people aren't focused on. Banks won't do it. The Ares and Apollos of the world won't focus on it. And we can create a higher return. And that in time should mean that everyone at Tacora gets paid the same, if not more, than they do at those big firms, because the returns make up for it over time. But I think it's a hard sales pitch because Apollo and Ares obviously have these big brand names. It's very institutional. It's like working at an investment bank 20 years ago. And then there's these small startup funds. But I think if the fund does well, you're really betting on the PM, you're betting on the team. But if the fund does well, you can make the same, if not a lot more money working at a small fund.
I actually am really, really happy you just said that, because so much of the community that we are in touch with, whether it be through social media or people who listen to our podcast, there has become this fever pitch obsession with the mega fund over the past several years, whether it be in the recruiting cycle, in the exit opportunity cycle, et cetera, et cetera. And I think that this narrative gets lost of, hey, guess what? How about you want to make the same money or more in a more nimble outfit? And again, you talked about recruiting from the VP level. We talk to these kids all day long who are like, hey, I'm 19. Am I too late for mega fund recruiting? Right? Like, I'm in 8th grade. Like, I didn't check the right. Yes. The answer might be yes. Whereas you're saying, not only do I want you to come up through the conventional training outfit of an investment bank, I also want you to go work at a startup, right? And I mean, the VP, it sounds so freeing to be able to have that breadth of experience before having to think about what the quote unquote exit is.
Not only that, I want to make one other point, which is I do think there's also this very different mentality between this sort of investment banking, private equity path, which is very formal military, right? You were an analyst and you were an associate. Like, you're not going to see some 25-year-old be able to start their own private equity firm unless, their dad is the one who is seeding that money. Like, you were able as a 25-year-old to be like, I'm running the credit business. Because I do think there is a much more reward-based system where if you're really good and you start in sales and trading, go like the hedge fund route, you can succeed on a much more fast, accelerated pace than if you go investment banking, which again is much more hierarchical. Your story speaks to that. Whereas again, someone who started in investment banking and then did the 2 years private equity, and then back in our day, it was like 2 years of business school, then back, you were 30 before you start getting Keri, whereas you're like, well, I'm 25 and I'm running this thing. So
you have to be very exceptional. Yeah. You have to be you. Yeah, you have to be the best of the best of the best, like discovering stochastic calculus in these models, right? So but it's there.
Yeah. Whereas I do think you can kind of just be a schmoozer, not to be obnoxious, but I do think that the bar is a little lower to getting into private equity. It's just you kind of have had to have known about it at the right time.
You have to have known about it. You have to know the path.
As a sophomore, then I need to start, get my investment banking internship. Then I need to recruit, 5 minutes after I've graduated. Whereas again, you have to actually have proven yourself if you want to go and be a kick-ass PM and make a lot of money in a hedge fund. It's a different animal.
To help your listeners a little bit, I could not find the next punch bowl quick enough when I was in college. I went to college and I was like, this is going to be 4 years of fun.
Yeah, me too.
I joined the ski racing team. It was a club team. They used to have a slogan, we're the drinking team with a skiing problem. And when I had to do recruiting at college, I didn't know what I was doing. I went to the career center and had them help me write my resume.
You're a perfect sales and trading recruit, right? This is, if you just cut and paste, this is me, except I slept through my Goldman Sachs interview my junior year because so way worse. But a lot of moxie, a lot of hard work, and a lot of raw intellect, and, kind of stumbling your way through it. That sounds like a great sales and trading candidate.
I was in research, but yeah.
But sales and trading and research, they're all part of the same division.
Same recruiting, yes. Yeah. But interestingly, the most impressive young person I met kind of through my travels was this guy named James Sagan. And he started his own fund at 25 years old. He never had traditional training. He never went to an investment bank. He graduated college, started doing deals, and then started his own fund. And it was $30 million in the private credit space, in this little South American niche, but he has worked for it and he has gotten it, and he runs hundreds of millions of dollars today. It's doable. You just have to have a lot of the word I use is chutzpah, but you just have to have a lot of moxie, whatever it is, to get it going. I never knew what I was doing. I always just kind of went to the next and tried to figure it out later. It all looks like a nice package in hindsight, but at the time it was I love the guys I worked with at DB Swire, and I didn't want to leave. I would have stayed with them forever. And, as great as they are and as wonderful as the firm they now work at is, which is the biggest firm in specialty finance or structured credit lending, which just got bought this morning. It's called Atalaya. I would probably be a senior person at Atalaya had I stuck with it, but never would have gotten on the own path. But I worked for such great people. I was okay, I've met these wonderful, amazing people. I'm never going to leave them. And then life happens and the firm started going out of business, and they went and became partners at Atalaya, but I was already at Third Point at that point and wasn't going to go leave to not run a business somewhere else. And these things just happen and they fall into place, and whatever path your listener is on right now is the right path. You just can't force it.
Yeah. I do think at the end of the day, if you ultimately want something, if you work hard and you just don't give up, I mean, eventually good things will happen. It might not be what you thought you wanted to happen, but like you'll end up in a place that was what was meant to be.
And be a good person. People politic, and like eventually it catches up with them. And so I do believe, I was talking to my dad last night about the awards in courage that, John F. Kennedy had written that book. And I don't think it's necessarily courage, but it's like always doing the right thing and standing up to people who do the wrong thing. And greed is a really nasty and like gross look, but people are greedy. It does catch up with them. You have to put your investors first. You can't put yourself first. It really is doing the right thing, always trying to be ethical, like look in the mirror and say like, is this something I'm comfortable with? Is this what I want to be known as? And so work hard, it will come, but you also have to like do the right thing, not politic, and be a good person.
I love that. Keri, this was absolutely amazing. Thank you so much. I mean, I'm like so fired up after talking to you, and thanks for being so patient with me here on my floor, because this is the only place I could get good Wi-Fi connection.
No, it's all good. I would come back anytime. And if you have young women who need advice, please send them my way.
You're amazing.
And where can people find you if our listeners want to connect? Are you on, I mean, I know you are on LinkedIn because I connected with you last night, but where can our listeners find you?
Keri at TacoraCap.com. That's KERI at TACORACAP.com.
Awesome. Well, thank you.
I love that you just gave out your direct email on this podcast. That is so freaking, I really like you. Thank you so much for coming on, Keri.
Thank you for having me.
All right. Awesome. Have a great night.
You too.
Bye.